US stock markets were down big on Monday and had another pretty big down day on Wednesday. A lot of financial market commentators are blaming this on the unwinding of the yen carry trade. In this video, I'm going to explain why the narrative surrounding the yen carry trade as an explanation for the decline in markets in the last week is very much overblown. Let's start out by explaining what a carry trade is. A carry trade is when investors borrow in the currency of one country at a low interest rate to invest in securities of another currency or denominated in another currency at a higher interest rate. The idea of people that participate in a carry trade is to capture that interest rate differential. Now, there are several factors that could trigger the unwinding of a carry trade. The two main ones are that the currency that you're borrowing in actually starts appreciating in value. And the reason that that would trigger an unwinding of the trade is that the investor has to actually repay the loan in the currency that they borrowed in. And so if the currency is appreciating, that means that they're going to have to actually repay a higher amount. And so that can actually cause investors to have to stop out of the trade. Now, the second reason why a carry trade might be unwound is if the interest rate differential narrows. If the interest rate differential narrows, then the trade is no longer profitable. In fact, sometimes the interest rate differential can actually flip, and therefore the trade is actually at a loss. So those are the two main factors that can typically cause the unwinding of a carry trade. So let's focus a moment on the yen carry trade, which has been the subject of a lot of commentary and a lot of speculation in the last week. Interest rates in Japan have typically, for the past several decades, been significantly lower than interest rates in the United States or just about any other place in the world. So many investors have adopted the strategy of borrowing money in Japanese yen and using those proceeds to purchase fixed income instruments denominated in currencies of other countries, such as the dollar. So for example, some investors might borrow money in Japanese yen at close to 0% interest rates and invest them in US Treasury securities that might be yielding around 5%. And the investor makes money by capturing that interest rate differential. Now, for many decades, there's been a lot of speculation about a potential unwinding of this yen carry trade. And the reason people speculate about it so much is that it is estimated that the size of the aggregate global yen carry trade is fabulously high. It's massive. There's some estimates that suggest that approximately $20 trillion are invested in various forms of yen carry trades. So therefore, the unwinding of yen carry trades could massively impact global markets simply because of the size of the yen carry trade. Now, I don't want to give the impression that I'm trying to play down the significance of the yen carry trade in global financial markets. However, I am saying that the yen carry trade as an explanation for the decline in equity markets in the last week is overplayed. I don't think that the unwinding of the yen carry trade was a particularly significant factor in the last week, and I also don't think it's going to be a particularly significant factor going forward, at least not in the next few months. Now, the first reason why this narrative has been exaggerated is that the narrative isn't taking into account the fact that the rise in the value of the yen in the last few weeks that was presumably causing this unwinding of the yen carry trade was following a massive decline in the yen over the course of the previous months. The rise of the yen in the last few weeks has merely equaled roughly the decline in the yen over the previous months. And so this didn't cause major balance sheet issues from a global perspective on the part of hedge funds or other institutions that use this as a strategy. What happened merely is that some of these hedge funds and some of these institutions gave back a lot of the gains that they earned during the first few months of this year. But they weren't in some sort of major balance sheet trouble that would have caused them to need to make massive liquidations in their portfolios. Now, the second reason that enables us to see that the unwinding of the yen carry trade really wasn't that big of a deal in the past week is the fact that US dollar denominated bonds actually increased in value. If there had been a liquidation of the yen carry trade, remember that people borrow in yen to purchase fixed income securities denominated in other securities like US dollars. And when the yen carry trade is unwound, people start dumping US Treasury securities. But that didn't happen last week. The US Treasury securities, US Treasury bonds actually increased significantly in value. So we can tell from that market action that the magnitude of this unwinding of the yen carry trade really just wasn't a big deal at all. And in fact, investors that were participating in the yen carry trade actually benefited from the rise of the US Treasury securities that they were holding. And this actually very much compensated for whatever currency losses, unrealized currency losses that they may have experienced during that week. So let's look at a fourth factor. This is a typical case of people mixing up correlation with causation. Just because the equity market was falling, people assume that the unwinding of the yen carry trade was causing this. But that's not the case at all. We can tell this for a couple of reasons. First of all, the yen carry trade is something that mainly affects the fixed income markets. People don't borrow in yen in order to buy US stocks. That's not something that really typically happens very much. It's a very minor factor. Now, the unwinding of a yen carry trade could trigger a decline in US stocks, but that would happen if US Treasury bond prices were falling and yields were rising. But that didn't happen. US Treasury bond prices actually rose and yields actually fell. So the fact of the matter is that you cannot use the yen carry trade as causal explanation for the decline in US equities last week. Now, what about the flash crash that we saw in Japanese stocks? Again, this doesn't really have anything to do with the yen carry trade. Nobody borrows in yen trying to take advantage of the low interest rates in yen in order to purchase Japanese stocks. That's really not a factor. The reality is that what caused Japanese stocks to fall was the rise in the Japanese currency. This always happens. Whenever the Japanese currency rises by a lot, Japanese stocks tend to fall. Why? Because Japanese exports tend to become less competitive, and that also causes a tightening of financial conditions in Japan. And so this was purely more of a domestic factor rather than having anything to do with the yen carry trade and the global yen carry trade. So we saw that US stock markets fell really hard on Monday, and we also had a bad day on Wednesday. So if it wasn't the unwinding of the yen carry trade, what caused this big decline in US stocks? First of all, there was a major crash in the Japanese stock market. And generally, when you get this sort of a crash, you get some sort of sympathy effect in other global markets. So yes, the decline in Japanese stocks actually had an impact on US stocks, but that wasn't a direct effect of the carry trade per se. Now, if a lot of you have seen my videos, and I really, really encourage you to watch my last few videos, I have been talking for over a month about the very high probability that the US markets could experience a major decline and even a flash crash. And that had to do with technical conditions in the market. It had to do with the positioning of value insensitive investors, such as CTAs and others. I really encourage you to watch my videos on these subjects because the US market was completely vulnerable, sort of offsides, so to speak. And any sort of a catalyst could have triggered the type of massive selling that would cause rapid declines in the US market. I've been talking about this for a while. We only needed a relatively minor catalyst to cause a sort of technical trip up in the market. Now, the question is, will this selling continue? Are we going to continue to go down in the US market? Now, from a purely technical perspective, I think that the worst of the selling is over. I think that from a very short-term perspective, short-term indicators suggests that the market will probably stop falling. We also hit on a very important zone of support, which I highlighted in my past videos. And I mentioned that I didn't really think the market would decisively break through that zone of support without more important fundamental catalysts. Now, again, I really want everybody to watch my videos in the last month, because I've been saying very clearly that the major catalyst that could cause a major decline in US stocks, not just a little pullback like we've seen right now, but an actual major decline in US stocks, would be the breakout of a major war between Israel and its opponents in the Middle East, Hezbollah, Iran, the Houthis. That is the big issue that everybody needs to be watching like a hawk. And what's interesting is that markets are pretty much ignoring this issue. But this is the issue that could really take down markets. And I explain exactly why in my other videos, and I really encourage you to watch those videos. So let's summarize briefly what we've said in this video and come away with some actionable things that we can do. To summarize what we've talked about, the yen carry trade was a minor factor in the declines in US and global stock markets this past week. Don't believe the hype. The yen carry trade is a big deal, and it might someday cause major problems in the global financial system, but that was not the case in the past week. And I explained very clearly that by looking closely at the market action, we can see that the yen carry trade really had nothing to do with what we were seeing this week in global financial markets. Now, what are some actionable takeaways? One of the takeaways that I want you to come out of with is that I really want you to subscribe to this channel, because I'm going to be watching this situation like a hawk, what I was referring to earlier, the situation that can really take down global markets, which is this conflict in the Middle East. And I've been analyzing the situation very closely, and I think it's very important that everybody follow this issue closely right now. And I'm one of the people in the markets right now that are paying most close attention to this issue. Second thing, I want you to join my free newsletter and my free community, where we actually have live discussions of this issue. And I'm going to put a link there where you can access this community, where we actually discuss this issue in real time during the day, intraday. It's a lot more frequent than my video posts here on YouTube, completely free. And finally, if you want to see what I'm doing personally in my own personal portfolios as a trader and as an investor to take advantage of this situation that is unfolding right now, I encourage you to check out my link to my Seeking Alpha Marketplace service. Check it out. That is where I have a model portfolio where people can actually see the real trades that I execute in my portfolios. And let me tell you, last week we hit on a massively good trade as a result of my anticipation of some of this volatility. So thank you very much for watching this video, and we'll be seeing you soon.